Hello everybody, it is Tortoise Investing coming at you today with another 5 dividend stocks that you can buy and hold forever. If you're new, please hit that subscribe button, show support and love. If you're returning, hit that like button, drop a comment down below. Doing all those things takes just a second and it means the world to me. Let's grow this thing on to 1,000 subs, 10,000, 100,000, and let's just keep rolling with it and grow our portfolios and the channel together. Now, without further ado, the stocks we're going to be taking a look at. We're taking a look at Hershey Company, Dollar General, Target, Nextera Energy, and AT&T. I know I've talked about a couple of these before. Still going to go through them because I think that they are at great prices. None of this is financial advice. Just letting you know that even though the markets have been going up and up and up and up this year, there are still sells out there to find. Now, Hershey Co. I recently got into this one around this price point, and I'm looking to add more. I like Hershey. It's got a great moat, and I think it's got a great future ahead of it. It has an adjusted free cash flow yield of 3.35%, dividend yield over 2% now, 2.07, and a payout ratio of 50.2%. Everything looks great to me. It's off its recent high of about 275. It's down to 231, so I looked at that as a buying opportunity to jump in. Revenue's been increasing at a rate of 6.75% over the last 5 years, but here as of recent, it has been increasing over double digits. Very nice. You like to see that. Free cash flow has also been increasing at a double-digit rate over the last 5 years at a rate of 12.76%. You love that up and to the right. That is so good. Growing revenue, growing free cash flow, growing EPS over the last 5 years, 16.69%. Absolutely amazing and a great compounder. If we take a look here at the dividend over the last 5 years, increased at a rate of 12.69%, and their last hike was a pretty big one here, going up from $1.04 to $1.19. Love to see it. They've been paying their debt down. It's currently at $3 billion. Their EBITDA is a little over $2 billion. No issues there in my eyes. When I look at companies, I don't like them to hold more than 3 times their EBITDA in debt. So this being 3, this being 2, perfectly fine. Now this is 2. If this was 8, that'd be 4 times. I'd have a little bit of an issue with that. But it's not that way. Love me some Hershey. Now, share buybacks is something I feel that they could do a little bit better with, but slowly over time, they are buying them back. I would like to see this to be increased, but it's hard to buy back shares if they're not cheap. And Hershey it's never been really all that cheap. You're paying a premium for a premium company. I like them though. And the return on capital employed from 2020 to now has just been rising slowly but surely at 1 to 2% a year. That is just such a good ROC. A return on capital employed above 20% is just so good. This company has so many things ticking right for it. I love Hershey. Now, Dollar General. Dollar General's got a lower adjusted free cash flow yield. They're having a rough year so far. So we'll take a look at everything regardless. They have a dividend yield of 1.38%, payout ratio of 21%. Not bad. Their revenue has been increased over the last 5 years at a rate of 10.03%, so very nice. The free cash flow, it's going to show negative here, and that's the reason being is this year they're down on their free cash flow. But if you take that out, as you see, you can easily see it's up and to the right. They are running into some issues, but I think they're going to fix it. Dollar General's ran into some hardships beforehand, and this is just such a strong company. They're opening up stores like crazy. I've got 3 within like 5 minutes of my house in like every direction. I like the company long term, and I think that they're going to get everything sorted out for their free cash flow. The EPS been increasing at a rate of 13.66% over the last 5 years. Very nice. Dividend, 15.2% dividend growth over the last 5 years. Another just so many check marks again. Debt is $5.7 billion. Their EBITDA is $4 billion. No issue there in my eyes. They are doing share buybacks. I do like that. I like that a lot. I hope they're doing that now, where the company is cheaper. Over the last 5 years, they've been decreasing their share count at a rate of 3.71%, and they've been increasing it as of late. I like this. I want to see this continue. It looks like they are buying back shares this year as well, decreasing from 235 now down to 226. Do that. I like that. The return on capital employed, not the best in the world. It was at 12.5% during 2020. It's now at 14%. Still pretty good. Pretty decent return on capital employed. Good little company there. Next up, Target. I feel Target is just unnecessarily beaten up. Before we dive into that, I didn't go over the price of Dollar General. Dollar General's down 31% this year. Right at $250, down to $168. So, as always, do your research. Now, Target. I like Target. Is running into the same issue that Dollar General is running into. It's having a free cash flow problem right now. They've got a dividend yield of 3.18%, payout ratio of 70.4%. That's a little on the high side, but I think they're going to get things under control. And we take a look at the revenue over the last 5 years, increased at a rate of 8.4%. Not too bad. The free cash flow, it's been increasing. Again, they had a big negative for the year so far, and a lot of this apparently is attributed to theft. They're having a lot of like theft issues from Targets. I'd need to do a little bit more research on that, but I mean, if you have a lot of issues with, lost merchandise and stuff, shrink is 100% loss of profit. So I can see where that's coming from. EPS over the last 5 years, slowly increasing. Again, this is kind of up and to the right, and they're having their little hiccup this year. Again, I think that's just temporary, and they're going to get things under control. Their debt's $16 billion. Their EBITDA is $6.6 billion. Not an issue there. If it was, let's say, $19 billion, that would fall in line with my this is over 3 times rule that I like to follow. Next up, the dividend. Dividend's been increased at a rate of 12.15% over the last 5 years. If you see here, they like to do big jumps, and then they do like little hikes, and then they do big hikes, and then they do little hikes. It's not very consistent. It's kind of all over the place, but still growing, still a good compounder in my eyes. I like them. Share buybacks is another thing that they're doing a lot of and heavily here as of late. Very nice. Buying back 5.6% of their shares in the last year. Love that. Over 3% in the last 5 years. Look at that share count just all the way down. Good. This is the only chart that we really want to see down and to the left, but down and to the right. But yeah, share buybacks, I like that. The return on capital employed, again, it's 11%. They're having a rough year this year with the theft issues and just free cash flow, so this is going to be lower. But before that, it looked like that they were tracking in the right direction. And I think Target's going to get back on track. I have no fears, no issues seeing them return to 200 plus in the next couple years. They were at one point $263 a share, now down to 132. So it's over a 50% decrease, or right at it. So Target, another one. Do your research, see if you like it. You might like it. Next up, the only utility that I like, Nextera Energy, off a recent high of $86 down to $70. This one, with all utility companies, you're going to have like negative free cash flow and a lot of debt. That's just how they work. They're zombies. They live off of debt, but they do it well. It's a dividend yield of 2.57%. Revenue's been increasing at a rate of 4% over the last 5 years. Not too bad. Free cash flow, it's a utility. It's going to be a mess. EPS over the last 5 years is down just because they had these spikes, and then it's down here. But we want to take a look here over the last 2 years, increasing our rate of right at 5%. So not too bad. And the dividend's been increasing at a rate of 11% over the last 5 years. And they said that they intend to grow the dividend by double digits through 2026. So another just strong compounder, and they are fully renewable, and renewable energy is the future. I like Nextera Energy a lot. It's the only utility that I would own, and I do own this one as well. But lastly, we got AT&T, the story of AT&T, the fallen hero that revived and then fell again. Let's take a look here. Just a free cash flow yield of 18%, very high. Dividend yield of 7.64%. The payout ratio, it's going to be a mess. It's going to be a mess. They recently cut their dividend. I don't see them doing another dividend cut. That would just be an absolute catastrophe. Their revenues just with this company, it's kind of all over the place. This is a recovery play. They spun off Warner Media, and they are trying to get back on track and be cash flow positive and just get their finances in check. And they're slowly doing that. If you look here, their return on capital employed is slowly going up. So very nice. And like I said, they did cut their dividend. It was increasing a nice little rate, but now down to 28 a share. Again, I don't see them cutting it again. So if you believe in AT&T long term, if you're looking for a high yielder, something that you're going to be able to just add to here and there and compound over time, again, not financial advice, but this might be something you want to look into. They have, like I said, been all over the place. They were in the 18s, then they dipped down the 14 area, and then they went back up to 20%, like above 20, and now they're back down to 14. This is the one step forward, two steps back. But I think they're going to start taking 2 steps forward soon. I know that they're having like the lawsuits over like lead in their wires, in their wiring cables. So yeah, this is a recovery play more than anything. Honestly, you could probably put Target in there as well. And Dollar General, really, honestly. All of these are beat up. A lot of stocks are beat up this year, but there are still values out there and great companies to be invested into. You just got to know where to look, got to do your own research, figure things out. But thanks for checking out everything. Make sure to hit that like and subscribe button for more. And until next time, see ya.